Assalamualaikum and hello everyone. This is the presentation on Mfrs 116, property, plant and equipment, and I'm Madam Yusna Liza, and this is the second presentation for part D of subsequent measurement and depreciation accounting. So let's start. And our session today will focus on straight line method, which is using the second formula, depreciation percentage multiplied with the depreciable amount, where the first formula that we have already discussed in the previous video, that was cost minus residual value divided by the estimated useful life. So let's apply that in this example, which is example 1. And example 1 is going to be a very comprehensive example. So example 1, if you see here, if you read the question, on 1st of April 2000x7. 2000x7 is actually the date of acquisition, because if you read further, you would see that the word here says the company bought a machine at a purchase price of 149. So this will actually be part of the initial cost, right? And the trade discount is given, so trade discount will be deducted in the initial cost. This will be added, and then you are also given a transportation cost that will be added to the initial cost, installation cost, which is necessary to install the machine. So this is to prepare it for its intended working condition, so this will be added. You also have the staff salary, the one that you can see here, which is salary. So this will not be included, this will be excluded, because these are actually revenue expenditure. And there is an information on residual value of the machine of 5,000. So make use of the residual value, because that will be the case for depreciable amount. You need to take the cost that you will calculate, then deduct it with the residual value. The policy of the company is providing depreciation. This is the percentage or depreciation rate. The percentage is 20%, where in 5 years time the asset will be fully depreciated, and that was on cost. On cost means straight line method. And yearly basis, yearly basis or annual basis, where you will charge full year depreciation. And you asked to calculate also for 3 years here, depreciation for 3 years. So let's do that. So first step is always to calculate the initial cost. So when you calculate the initial cost, as I've mentioned, the trade discount must be deducted against the purchase price and added with the directly attributable cost. So your initial cost is 150,000. Depreciable cost must be calculated by taking away the 5,000 from that cost, which is the initial cost. So the depreciable amount or depreciable cost is 145. That will be the one that will be used in the calculation of the depreciation charge for 2000x7. Before that, I extract the information relating to example 1, where that was on cost. That implies straight line method again. And a yearly basis, where you will charge a year depreciation even though the machine was bought 1st of April. 1st of April, this is actually the year end is 31st of December. So for this period, it was just around 9 months. So therefore, even if the asset is with you for 9 months, right? 9 months, but you still need to charge full year depreciation. So here, so you get depreciable amount 145 times 20% times 1. 1 here represent 1 year. So the 1 year means because you charge as if that has been with you for 1 year or 12 months, even though it was just for 9 months because of the yearly basis. Next, the second year will be the same, because that is the principle under straight line method, same depreciation for the same asset each year if there is no changes to the asset. Third year is also the same. So for 3 years, they are all the same because this is yearly basis. This is the calculation of accumulated depreciation net carrying amount for yearly basis. The first year, you can see the depreciation is here, the accumulated depreciation is the one here, and at the end of the year you will take the accumulated depreciation deducted with the cost. Remember, it is the cost minus accumulated depreciation. AD is accumulated depreciation. The second year, 2000x8, you will have the previous year balance added with the second year depreciation, and that would give you the depreciation where accumulated depreciation will be 29 minus 20 plus 29, sorry, 58. So that gives you this amount, 58,000 as the accumulated depreciation, and your carrying amount is 92. Note that this will be used in the other example as well, the information in example 1, that will be used for presentation and also for the movement of PPE notes. The third year is also the same, right? Only that in the third year you now have depreciation which is 29, but the accumulated depreciation has grown to become 87, right? And because of that, the net carrying amount has reduced to 63. So the later years, the net carrying amount becomes lesser. Next, this is the second example here. This is on straight line method but monthly basis. Here you can see that these are the information on the purchase price. Trade discount is given, so 2% from here, the same thing, 1,500 and 2,480 will be included, as this is similar to the previous example. If you can check, you can go and check that this is actually similar. Yeah, this one, example 1, but now it becomes example 2 with just the changes in the basis from yearly to monthly. So residual value is still the same, everything is the same, so information are the same, only that the basis is what makes different. The rate is the same. You can see that the rate is still 20% on cost. Method is still the same. Repeat the same calculation for 3 years. Same, not same calculation, the same depreciation that you need to calculate now is for monthly basis. So before that is the same 150,000. It's the same depreciable amount. But now we go to the year end, to calculation for the depreciation for 3 years. We extract the information here. So on cost, monthly basis, cost means straight line method. But monthly basis, it means that depreciation will be charged based on months to month. And because you bought for 9 months, so the depreciation will only be charged for 9 months in the first year of acquisition. So therefore, in the first year, 9 months here, 20% is the rate, 145,000 is depreciable amount. So 9 months, it refers to the monthly basis or the proportion of the year. Yeah, that was 9 over 12. Second year, still based on a full year depreciation, and third year still charged in full. Only the first 2 years is going to be 21. The first year will be 21,750 because of the 9 months. The remaining will be the same. Now we go to reducing balance method. How do we calculate depreciation under reducing balance method? And please recall, the reducing balance method will not make use of the residual value, as I mentioned in the previous video. So the machine that was bought here is 90,000. There is a cash discount. This must be deducted. Cash discount. Supplier price to be added. There are installation. This must be added. Testing cost must be added to get the initial cost. Administrative costs, these are not included because these are expense of capital. Expenditure are only those that are being added, but admin cost is revenue expenditure. There is a residual value. Even though there is a residual value, you are not going to use the residual value in the calculation for reducing balance method, because residual value only applies for straight line method. The basis is yearly. So let us look at the calculation under reducing balance, as the theory says that more depreciation will be in the earlier years, less depreciation will be in the later years. So the same thing, calculate the initial cost. Take note on the percentage of cash discount that was based on the purchase price, and add the testing costs and installation. Do not include the admin costs. So that is the initial cost. The depreciable amount in the year of acquisition, depreciable amount is still equal cost. It is not going to be deducted with the residual value. Residual value is not applicable. So this is in the year of acquisition, which is a year ending 31st of December 2007. Let us look at this is the year of acquisition, YOA, year of acquisition. So in the first year, you can see that the calculation of depreciation are based on cost, 9900, and there is no residual value applicable, 15%. And for 1 year, so this is actually multiply 1, this one also multiply 1 and multiply by 1, right? That was the first year. So you get 13,635. In the second year, under reducing balance method, depreciation is calculated on net carrying amount. The first year, the net carrying amount is still the cost because the first time that you provide depreciation. But for the second year, the net carrying amount would be the cost minus accumulated depreciation. So this is the cost, 9,900 for the second year, and the accumulated depreciation is 13,635 because only 1 year depreciation that has accumulated. So therefore you will have the net carrying amount to be 77,265 and multiplied by 15%, and that gives you 11,590. So there is a decreasing pattern there. You can see there is a decreasing pattern. The third year, you will see that the accumulated depreciation, this is the accumulated depreciation, where that was the depreciation here, and the depreciation, what happened is, is the accumulated depreciation, which is going to be the depreciation for 2 years, which is 13,695 and 11,590. Let me just take a different color for you. This one and this is the one here. Okay, so that was the accumulated depreciation for 2 years, right? So therefore that gives you 65,675, and this is the carrying amount. For the calculation of depreciation, net carrying amount is 65,675. So it is 9,851. So depreciation are still charged for 1 year period, even though bought on 1st of March because of yearly basis. This is the calculation, the accumulated depreciation in the table form. The net carrying amount for that first year, cost minus accumulated depreciation. So this is the cost, this is the accumulated depreciation. Again, this is the cost, and this is the accumulated depreciation, which is depreciation for 2 years. So that gives you this amount of 25,225, which is the two amount of depreciation from the previous year and the current year. And the third year, depreciation are charged again, and therefore the current depreciation is 9,851, but the accumulated depreciation would be the one that you added here, all these three actually. Alternatively, you can take 25,225 and divided by, just get my pen, a different color for you. This one, 25,225 plus 9,851, you get the same here. and the accumulated depreciation for 3 years are being deducted to arrive at the net carrying amount at the end of 30th of June 2009, where you still take cost minus the 3 years depreciation that is called accumulated depreciation. You accumulate that. Next is the second basis, which is monthly basis. So it's another question. Supplier price 90. Remember, this is the purchase price. Trade discount must be deducted, and you need, even if you have not taken up, that is assumed to be included there. So therefore, installation cost 1,000, testing cost 2,600, admin cost shouldn't be included. Admin, these are included, these are included, these are included but deducted, this is also included. And the residual value, remember, we are not going to include residual value. Now it's monthly basis, reducing balance method. The same year is selected to calculate depreciation. So first extract the information. So these are reducing balance method, monthly basis, and reducing balance method are calculated based on net carrying amount, cost minus accumulated depreciation. Remember, in the first year it is still on cost. Only the subsequent year it will be based on the net carrying amount or the carrying value. So for the year ended 30th June 2007, it will be based on the 4 months ownership, month-to-month ownership, because yearly basis, this is monthly basis, and that was in the first year for 4 months. You bought it on 1st of March, and the year end now is not 31st of December. The year end is not a calendar year, it is 30th of June 2000X. 8, 9, and 7. So let's look at the first year. First year, there are no accumulated depreciation, so the net carrying amount is the cost, right? And the first year is where you use the proportion of ownership 4 months, 4 over 12. So you have the first year depreciation, and that is based on 15%. For the second year, so the accumulated depreciation is actually the one that you will start having it only somewhere 30th of June 2007. So by second year, there is an accumulated depreciation from the previous year, 4545. So that is being deducted. This is the cost minus accumulated depreciation, and for this is charged for 1 year. Only the first year that you take the monthly basis into consideration, but in the second year it will be full 12-month depreciation. The third year is also the same case, 12-month depreciation, only that the accumulated depreciation will be higher because that was as a result of 4545, and then also the result of 12953, which is the depreciation for the last 2 years. So the depreciation for that year is 11,010, which is actually somehow decreasing in the second and third year, but in the first year it was the lowest since we use monthly basis, and it was just with us for just 4 months. Next, let us look at the presentation and disclosure in the financial statement for the depreciation, cumulative depreciation, and the net carrying amount. And these are the accounting entries for the depreciation. So if you refer to example 1, you would see that depreciation charge was 29,000. You can refer to example 1 at slide 38, right? So depreciation will be debited, and that will be depreciation related to motor vehicle or maybe machinery or building. You have to have a separate account, and the accumulated depreciation, which is a contra asset account, will be credited. And this depreciation is an expense, and it will either, if it's not stated normally under admin expense, but however if it's used for selling purpose, it will be under selling expenses or distribution expenses. So this is how you close the depreciation. You close this is how you record for the year. Every year must be recorded. So let's look at the depreciation charge for the period. It is recognized as a depreciation expense yearly in the statement of profit or loss. Disclosure for depreciation, presentation and disclosure. Right. Where expenses will be shown every year as depreciation will be under admin expense. If it's under admin expense, it is actually operating expense and it is a non-cash expense, so we need to include that. Let's apply that as well in the disclosure. This is the sample movement of PPE notes that will normally be relevant to our context of FAR210, and we'll be making use of this in our example 1 in a short while. So let's look at the presentation here. The presentation must be at the carrying amount. Carrying amount again is cost minus accumulated depreciation. That is carrying amount. So that must be the amount from the one at the end of that particular year. So let's look at the example slide 1. Slide 1, if you can still recall, the depreciation was 29,000. So this is the record for first year. Record depreciation and close the depreciation. The second year, 2000x8, you can see the same charge for 2000x8. And now we go to 2000x9, also the same. So every year is the same because straight line method. Next is the presentation. This is the presentation for 3 years. You can see depreciation are the same. This is how you put in under the statement of profit or loss. It will be totaled up under the expenses first. If you have prepared for publication, you need to go and settle the expenses under admin expenses, include the depreciation. But here it was just an extract statement of profit or loss for 3 years. So you can see that they are all the same. Now let us look at notes to the account. So you can see the depreciation is here. So these are included under accumulated depreciation. You have to show the cost and accumulated depreciation, and depreciation are charged there, but the carrying amount will be different for the 3 years. And this carrying amount and also the movement. For the movement of PPE, there are no beginning balance for the first year, but you acquire in the first year. But in the second and third year, there are no further acquisition of PPE. So for the machinery, the first year, no balance for accumulated depreciation. Second and third year, there is a balance. So these are the carrying amount for each year, and that carrying amount will be shown in the soft P, or it will be shown as the figure in the non-current asset under property, plant and equipment. This is the non-current asset of section extract statement of financial position for 3 years, 121, 92 and 63. Again, this is based on example 1, slide 38 answer. Right, we take a break first and we will continue with our next session, revaluation model, after your coffee break. Until then, I'll see you when I will see you. Stay tuned with my next video, and Assalamualaikum and have a pleasant day ahead.